If you've been in crypto for any amount of time and you're not seeing the results you want because they're inconsistent, this video is going to show you exactly why that is. So let's start out with why you're losing trades before you even take them. Now, the majority of this has to do with mindset. So before you even open the app, your mind is conditioned to go find the same patterns that you've used for months, if not years, to find the same opportunities, right? That's what you're trying to do. You're trying to find opportunities so your brain is primed to find those coins that you want to buy that are going to gain you that return. The problem is the process that you've been using to find these coins has not changed. You're simply changing the coin you're buying, but you're not changing the mindset, the process which these coins are choosing. So we cannot solve our problems with the same thinking we used to create them. So what this looks like is you lost money on chasing this pump. Let me go chase another pump to make up for the first loss. However, the process that brought you to the first coin, which failed, will most likely lead you to another failed result. Same trade, different skins. Now, if you guys have ever played any kind of video game, whether that be Valorant, Counter-Strike, League of Legends, you're playing the same character, but you're changing the outside skin. They have the same skills and abilities, but your main character remains the same. You are that main character, and the skins are the coins. So you need to change the character you're playing. You need to change your process to be able to change the outcome, because without that, you're simply playing the same character. Now, typically, the average investor, what they do is to find opportunities is they walk into the casino, right? Deck screener is the casino, and you have all these numbers flying at you. If it's not deck screener, it's FOMO. If it's not FOMO, it's Axiom. Whatever trade terminal you're using, there are these options and numbers flying at you, and you're looking for momentum, you're looking for an opportunity, right? You've got Wish, that's up 784%, so you go ahead and buy that because it's moving fast, and you want to make that money, right? But this is actually the wrong approach. If you're using any kind of momentum or current movement or current attention to buy these trades, you're most likely going to be buying off the backs of people who've made profit and who are going to dump on you. People you see on the timeline saying this is the next big runner, it's most likely not going to be the next big runner, but it's going to profit the people who you are buying off of because they get to sell higher. This is a ruthless game. So when you're browsing the top gainers, the new pairs, the volume, momentum, and excitement, what you should actually be doing is checking what kind of attention does this have? Is it long-lived? What kind of narrative am I following? Is this a big narrative or a small narrative? Am I late? Looking for the right criteria. So there are ways to decipher what kind of attention, if it's good attention or bad attention. I can give you some examples later on, but the real quick one I'm going to give you is we recently had Elon Musk call Sam Altman scam Altman. Now, this was a tweet type play. Tweet type plays have very low attention life because they're simply based off of one tweet and they move up and then simply lose their attention because they have no legs to stand on. Elon tweeted it with no intention of creating a coin out of it, and then the people who created the coin thinking it's going to make them money, but then because it was unintentional, the coin simply fizzles out. What kind of narrative is it? Well, that falls under the Elon narrative, which is actually pretty strong, but his narrative power has been declining since he has a lot of coins out there, and it dilutes the amount of capital that can flow into an Elon coin unless there's an exception, right? And am I late simply means, are you buying a coin that has pumped 784%? Or is trading sideways and has pumped a mere 20% and is accumulating, right? That's the difference. So instead of going for the excitement and momentum, you want to look for certain checklists, okay? You're looking for the right criteria. You're not looking for excitement. You're looking for the criteria. So if the chart doesn't meet your criteria, and I'll go into this later, you're simply not going to be interested in buying it. Now, let's move up to some of the other problems people face when they're on deck screener. They have a scarcity mindset. The belief that opportunities are scarce. If you miss this move, you will not get another one. The solution here is realizing since the market has began, it has not stopped producing opportunities. Every week, someone else is talking about a new opportunity, and that's just how it goes. The market will keep producing opportunity as long as the market is running. You will never run out of opportunities. However, you will run out of capital when a good opportunity comes along if you keep thinking in this scarce mindset. You have to adopt an abundance mindset where if the coin does not meet your criteria, you're simply going to wait for a coin that does, because that sets you up for success. Your job is not to catch every move. Your job is to catch the ones that meet your criteria and let the rest go. This is incredibly hard for people to do because they simply want to click the button. So what happens when you adopt the scarcity mindset? Well, coin hopping. This is the main problem. This is a symptom of FOMO and lack of trust in your conviction. The moment something shinier appears, your conviction in the original setup dissolves. And what happens here? The coin you jumped ship for ends up going down, and the one you were originally in, being patient with, ends up moving towards the upside. I can guarantee you guys, many of you who are watching this are saying, this has happened to me. That's because this is a common symptom of not having the right system, not having the right mindset. You are simply following the money and donating your money to the market and to the traders that are manipulating you into buying the coin they want you to buy. So these are just a couple of symptoms of not having the right mindset or not even having a system to buy on-chain coins. And this is because most people go off of feeling, right? You're going off feeling. So what happens here? It's inconsistent. When you enter, it's green, and when you sell, it's red. You buy high and sell low, the complete opposite of what you're meant to do. That also creeps in with volatility. You feel confident when the chart is green. However, when the chart starts to dip, your confidence goes down along with it. That means you're not really investing with a system. You're investing based off of stimuli. Chart green equal good, chart red equal bad, which means you're most likely going to sell. The trade felt right when you took it. And then you say, no, I picked the wrong coin. You picked the wrong mindset, and the coin was the consequence. Because you had an unprofitable mindset, it led you to picking this coin. So the coin wasn't the issue. It could have been a different coin, but as long as you have the same mindset, you will always pick the wrong coin. And this is what I want to drive home. When you have the wrong mindset, your perception filters everything that's good because it's slow and boring and focuses on the fast because you think fast money is going to get you to your destination a lot quicker than being patient. And that's actually the inverse. It's the patient, slow cooked plays that get you to where you want to be. Of course, there are exceptions to this in times of high volatility where the market is moving extremely fast and there's a lot of liquidity. There are exceptions to this, but if you don't have the right mindset, you're not even going to identify those coins anyway. Now, in a bit, I'm going to show you exactly what to look for in terms of a criteria that's very specific that I've uncovered through observation that can be extremely profitable, but you need to have the playbook. So we'll get into that in about 2 minutes, but first, let's go towards what you actually see when you're looking for the market. So two traders will look at the same chart, but see different things. Trader A, clean, right? He knows what to look for. They have a criteria and they have a set of specific conditions that need to be met before they can invest. And they say no to a lot of charts before they say yes. Trader B, on the other hand, is primed. They're all ready to buy, failing for confirmation bias, betting on betas and avoiding the leaders, right? And usually you see something like this, and this is not me dunking on Miyamoto. It's just a tweet I pulled up randomly that gets your emotions going. So why I think LFI is the next 100x on base. When I decided to retire from base, it was clear to me that I wouldn't touch a single token there unless things fundamentally changed. Now, the problem with this is he has a completely different framework to investing than all the other people watching his tweets. He knows what he's looking for. He knows what he can sit through. He has a set amount of capital he's willing to risk. However, you don't. You need to be very strict with your capital. There are hundreds of traders out there, hundreds of influencers that are calling one token the next 100x. But what you need to do is verify that this is true using your own framework, because that gives you confidence to hold if that is true. Otherwise, when price starts going down, you're simply going to lose. And when you're on Twitter, you don't know it, but you're doing the same type of thinking. You're browsing for new pairs, and there's nothing wrong with that. However, you need to be like Trader A and knowing what to look for. So I will find a tweet like Miyamoto's with LFI, and then I'll go verify it for myself. Is this a coin I'm interested in because it fits my criteria, or is this already pumped and there's too many people sitting in profit and I'll simply get dumped on as soon as I buy? You need to know what to look for. That's just one criteria. The next one is, what kind of setup is this? There's 10 different setups that I've identified in the last 9 years. And if this coin doesn't meet one of those setups, I simply ignore it because I don't know the playbook. There are playbooks in this market, and I'll show you one here. So let's move on to the playbook section. Here's what you're missing. The certain playbooks. Now, there is a couple of them that I've identified through observation in the past couple of years, and one of them is called the 20-6 play. Now, you guys have probably heard about Fartcoin, and Fartcoin has the specific play demonstrated, right? We have an impulse move towards the upside to 23 million, and then what does it do? It falls down to 6, and then from 6, it moves up to 40 million. The important part of this playbook and setup is that it goes around 20 million. It doesn't have to be exactly 20. It can be give or take 20%. Doesn't matter. The markets are volatile. But when you see this setup and it tops off at about 20 million, you can expect it to go between $5 to $6 or $7 million when it retraces. We have that again here on NON, and this went on to $300 million market cap, right? This was in its early days. So it went all the way up to 18 million and then came down to 5.57. And then from there, we actually blasted off. Now, the important thing here is to understand the anatomy of this trade. If this trade meets the certain criteria, it will likely bounce from 6 million or 7 million or 5 million. Now, the specific way I use this playbook is if there's a coin running and it's got a lot of attention and I see it move past 11, past 15, past 16, I don't FOMO into the coin because I'm looking for a certain reaction. A coin doesn't go up forever without pulling back. I mean, we saw it even on Fartcoin, right? This one went on to $2 billion. So we do get pullbacks. Actually, we get a lot of pullbacks. So you can see a pullback here at 28, at 40. So we do get the pullbacks. So that's what I'm looking for when it comes to this type of play. This is how it helps me. I know eventually we will get a retrace. And if we get that retrace at 20 million, I have an idea of where to look and where to wait if I want to buy into a coin. And that's how I use these playbooks. I always look for the zones. They typically go revisit before blasting off again, because that's how I increase my risk to reward. I buy as cheap as I can and then ride it towards the upside. The difference between buying at 20 million and buying at 6 million is massive, because 10xing from 6 million is simply a 60 million market cap coin, which is much easier to achieve than it is buying at 20 million trying to get to 200. So that's why it's important to be patient. Even when the emotions are firing, you need to be patient and wait for the playbook to play out. And I actually have a live play of this today. We have a coin that is very similar. Not this one. It's actually this one, Bernie. So Bernie went to 21 million, around 22. Now it's sitting at 12. Most likely, if I was interested in this coin, I'm looking at the $6 or $7 million level to buy here. But I won't buy unless it passes my framework test. This is what I'm talking about. I have a criteria. If you guys want to know my criteria, you can simply click on the link for the PDF down below. There are 5 signals that I look for, and it helps me filter whether I'm interested in this, because knowing this setup is just one part of the puzzle. You need to have the rest as well. I know the 26 setup, right? But how do I know this still has relevancy? Well, I take it through my checklist, and then I decide if this trade is right for me. First, I check if this meets one of my predetermined setups. If it does, run it through the checklist and then decide. Now, another thing I want to talk about here is narrative power. And you can see this chart on Goblin, right? This chart was spawned because ChatGPT started hallucinating about goblins and taking an obsession towards goblins. So you can see the price is at $1 million, but buying at $1 million at this point, when it first shot up, is a lot less riskier than buying down here. And the reason comes down to this idea of narrative power. The relevance of the project is fading from the original point of attention. When we were at $1 million market cap here, the attention around goblins and ChatGPT was really high, because we even had Sam Altman talking about this hallucination. So the point of attention here was extremely high, and there was a lot of eyes on this. However, when we come down here, the money has been spent, the volume has been spent, and we don't know if this is going to be a long-term narrative or a short one. So when you buy here, it's a lot less riskier, because this coin went from 1 to 4. You could simply buy your portion here, take off half after a double or a triple. Now you're risk-free. You don't have to worry about this coin anymore. You can simply let it ride or die. Up to you if you want to secure that profit as well. There's a lot of ways to play this once you get risk-free. So the idea here is that the closer we are to the attention event, the easier price will be able to move. You are using your momentum to reduce risk. The momentum right now at $1 million here is a lot lower than it was here, because the energy is spent. I hope this is making sense to you guys, because if you can get your money in during the momentum phase, you will reduce your risk after this move up. And now you're not worried about what happens, and you can actually hold out on this coin. It's extremely important for meme coins because they're extremely volatile. You can also use this idea for fundamental coins, but fundamental coins right now require more liquidity to move. They don't act as much of a sponge for liquidity as meme coins do. Now let's move on to how this affects your decision making. Now let's move on to the decision making process of all this. So when you're making a decision to buy the coin, you're going to be feeling some emotions usually, especially if it's a bad process. If it's a bad process, you'll be feeling urgency, excitement, pressure to act right now, FOMO, sprinting to a DEX to buy, feeling excited. The problem with this is that there's many problems with this, but one of them is it makes bad trades feel like good ones because you're taking action. You enter late, momentum slows, price pulls back, and you sell at a loss. This is the outcome of this kind of process, emotion-driven process. You'll find yourself one day being excited about a narrative, and then the next day you're excited about a different one. So this is the problem with emotion-based trading. Your decisions are based off feelings. And another problem here is that you'll see posts like this promoting $37,000 in 120 seconds. Ethan Prosper has to be somewhat goated at this point. They're promoting fast money, and you don't even know if what you're seeing here is real. You don't know if this post is real. This could be made up. So people are promoting fast money because it's akin to gambling. Easy come, easy go. There's no guardrails. So doing this is not exactly what you want to be replicating. You have to ask yourself, am I early? Am I late? What kind of market conditions are we in? This is the most important one, because even if I have the right setup, even if I have the right framework, if I'm playing in the market conditions that don't support my setup or my framework, it doesn't matter. The best framework, the best setup won't work in bad market conditions. Very important to recognize. Now, slow money. The money is made in the waiting, and it's made in the waiting for right opportunities to come, and then it's made in waiting for the coin to actually move, and it will take time. So this video is all to say that It's all been decided before you even get to the end point, because the outcome is equivalent to the process, right? And if you have a bad process, your outcome will be bad. However, if you have a good process, then it'll most likely be good. So you have to take into account the whole journey that it takes you to buy a coin to recognize what the outcome is going to be. And it's okay for a good process to have a bad trade, right? Because that's just variance. You will have good trades and bad trades using good process. But if you have a good outcome using a bad process, you're simply building bad habits. And in the long term, that's not going to serve you. You'll simply get destroyed over time. So if you found this video helpful, make sure to leave a like and let me know down in the comments if I hit any pain points specific to you. And like I said, if you guys are interested in the framework, the PDF is in the description down below, completely free. But that is it for today's video. Happy trading, and I'll see you guys next time.